What's going on, guys? Hope you're having an absolutely fantastic day. So today I want to talk about why I just bought Warner Brothers Discovery stock. So I'm pretty sure everybody has heard of Warner Brothers and also Discovery, right? Because Discovery Channel and Warner Brothers pretty popular mode and brand, right? So what you may not know is they own all these brands, right? Like TLC, maybe the NBA. So before this, I didn't really know all this as well, right? So really have to take a deep dive, right? And I'm pretty sure I don't know everything that they own, right? So if we take a look at Warner Brothers Discovery stock, you can see that it's obviously been absolutely decimated since it came public, right? So 6 months ago when it came public via merger, obviously since then it's gotten destroyed, right? And the reason for this can be found in this book, right? So basically, this is one of the reasons I'm investing in this stock as well. Because when there is a merger or a spin-off, right, which in this case, it was a spin-off and a merger, right? So most of the time, what will end up happening is the people who hold these shares will just end up dumping it, right? Because let's say you buy Alibaba and then they give you some random shares of this ABC company, then you don't really understand that company, so you just dump it, right? Most of the time. So obviously, Warner Brothers Discovery's shareholder base will be very different from the company that spun it off, which is AT&T, right? So AT&T investors are mainly dividend investors. So when they get this Warner Brothers Discovery, they just think of it as like, oh look, free money that I can sell off, because they just want the dividend, right? So obviously I showed you this book. It's by Joel Greenblatt, and if you don't know who he is, basically he's one of like the great investors, right? So 48.5% compounded over 10 years through a combination of special situation and deep value investing, right? So this is kind of a special situation because it only happens once, right? And of course, this record is a bit cherry picked, right? Because his record obviously is 20 years, but they only show 10 years, right? But I think over the 20 years, he had something like a 30% annual return, right? So I think that's a record that all of us would be proud to have as well, right? So the second reason for buying this stock is also obviously inflation, right? So this stock, we're going to take a look at it later, but this stock has a lot of debt, right? And you're going to find out later why. That I think actually this is a good thing. So if inflation is at 9%, depending on the rate of where you carry your debt, right? Basically what interest rate you carry your debt at, it can be actually a good thing or a bad thing for you, right? That's why people always say real estate is a good investment during inflationary times, right? Because the fixed cost that you pay, let's say you have a fixed interest rate and you pay let's say you pay 3.5% and the inflation rate is 9%, right? Basically, anything between that, the 9.1% minus the 3.5%, which is what? I think it's 6.5% if I'm no 5.5%. So you make 5.5% on the inflation, right? Basically, because you can raise rents according to inflation in the theoretical scenario. So let's take a look at the third reason that I really bought this stock, right? So obviously during these times, high volatility, high uncertainty, you want some sort of catalyst, right? I would say, just to give you some margin of safety, and this would be the catalyst that I'm really looking for. I'm a big Game of Thrones fan, right? And I'm sure a lot of people on the planet are big Game of Thrones fans as well. So there's this series called House of the Dragons coming out, and basically it's coming out on the 21st of August, right? It's premiering on 21st of August, which is about 2 weeks from now. And I think this series can easily bring in 1 million or 2 million subscribers to HBO Plus, right? Which is owned by WBD, right? So why do I think that? And I think this customers will be quite sticky because this series is before Game of Thrones, and what ends up happening is a lot of Game of Thrones fans, they might have unsubscribed to HBO after all the Game of Thrones was over, right? Because some people actually do that, right? Because you have one series that you really like, and after that there's just nothing to watch, so you unsubscribe, right? So when this House of the Dragons come back, I'm pretty sure that a lot of these Game of Thrones fans will come back and subscribe, and then they'll watch Game of Thrones again, right? Which stops them from churning so quickly. Maybe their customer lifetime will go up from, instead of maybe just a few months when this series is out, or 1 year when this series is out, maybe it'll go from that until 2 or 3 years, right? So obviously, if they decide that you know, they want to watch House of the Dragons and then they want to watch Game of Thrones, obviously their customer lifetimes increase, right? And maybe they will even stay permanently after that because they discover something else to watch, right? So those are the three catalysts. So now I want to really take a look at the financials of this company, right? So Warner Brothers Discovery, obviously huge library, 200k hours of video content, obviously big library, right? And I just want to stress this, right? So let's take a look at Netflix's valuation, right? So Netflix currently trades at a market cap of 103 billion. Obviously, I'm just taking a one-to-one comparison here. So obviously, Netflix is in a better balance sheet scenario, better profitability, blah, 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 whatever, right? So I'm just taking subscribers to subscribers as a count, right? But Netflix's valuation is 103 billion. So, and they just have a streaming platform. HBO itself, right, has, Warner Brothers Discovery has 92.1 million subscribers as of this quarter, and they're trading at a market cap of 34 billion. And that is not their only business, right? Oh, and by the way, if anyone is interested, what price I bought it, I basically bought it at $14, right? And I really hope it goes down over the few days so I can accumulate at a cheaper price, right? Because I have not maxed out my position, and I plan to make it around 15% of my total portfolio, and maybe even more after that. So obviously, if you look at it at a one-to-one just subscriber basis, WBD obviously is undervalued, right? So just taking a look at this, basically this is the merger document from last year, May 2020, right, I believe. So portfolio position to stronger partner advertising and distribution counterparts, because these two companies are actually good merger fits, right? So obviously there are some companies which are bad merger fits and some companies which are good merger fits. These two companies combining makes it a total powerhouse, right? And this is really the thing that sold me, right? Greater scale with 52 billion of revenue and 14 billion expected adjusted EBITDA. So targeting 15 billion of revenues from direct to consumer in 2023. Significant synergies with 3 billion of expected run rate and cost savings. So basically, due to the merger, they might not need some positions or some executives. They no longer need them, right? They're redundant, right? Because you don't need two people to do the same job. So they expect to save 3 billion, I think, in 2023, right? So from now to 2023, they expect that their cost cutting will save them 3 billion. So robust free cash flow supports deleveraging, reinvestment, and financial flexibility. And one thing I want to say about all these spin-offs, right? Even though they have a lot of debt, right? Usually the two companies that are spinning them off, or the company that's spinning them off, right, will give them enough assets and also enough free cash flow for them to not go bankrupt, right? Because it's a bad look if you spin off a company and it goes bankrupt, right? So next time investors will think, you know, when you do this, they won't buy it from you at such a high price because they think that you're just saddling the company with debt and just basically dumping the shares on investors, right? So committed to maintaining investment grade ratings. So that doesn't really matter to me. This matters to me, right? So expected rapid deleveraging. So they plan in 24 months to delever from a 5x leverage ratio to a 3x leverage ratio. And I want to talk about one more thing which I had open here. So yeah, I have this open here, right? So Discovery, the company, Nasdaq WBD today reported financial results for the quarter ended June 30th, 2022, right? So if you really want to invest in this company, I urge you to listen to the earnings call, right? Because the earnings call has a lot of things that they don't mention in all these reports and you might miss in all these reports, right? So basically what they say in the earnings call is by the end of August, right, they plan to pay off 6 billion of their debt. So obviously that is a very, very good news for us, right? And also in the earnings call, they talk about the debt a bit, which I will take a look at later because it's on another slide. So 60% free cash flow conversion. This is the thing that mainly sold me, right? So if I'm basically investing based on a free cash flow basis, right? So if you take 14 billion that they expect and it times it by 0.6, which is their 60% free cash flow conversion, right? It's 8.4 billion. And if you take a look at what the stock is trading at, 8.4 billion on a market cap of 34 billion, right? So it's about a 20% free cash flow yield, right? Let me just do that. So it's a 4 times free cash flow multiple, right? Basically meaning that it's a 25% free cash flow yield, right? And to me, that is a huge margin of safety, right? So let me address the big concern which I had before making the investment as well, right? Which is debt, right? So we are going to go through the recent financial statement, right? So Q2 total reported revenues were 9.2 billion, so about 10 billion of revenue in a quarter, right? So you can see that these companies have options, right? Not it's a company trading at a 34 billion market cap, has a lot of debt, but they have 10 billion in revenue, right? And that is a good thing when it comes to inflation hedging, right? Because they have the revenue and the capital outlay is behind them, right? They have already laid out the capital, right? So net loss available to Warner Brothers Discovery Incorporated was 3.4 billion, basically. Includes 2 billion of amortizations of intangibles. Basically, these are like goodwill, things like that, right? 1 billion of restructuring and other charges, and 983 million of transaction and integration expenses, right? So this should go away. So 2 billion of it should go away, and 2 billion of it really doesn't matter, right? Because this is cash outlay in the past, right? And we only care about the company's future. So these capital outlays, I don't think are really cause for concern, right? Because it's not actually even a cash outlay, right? It's just numbers on your balance sheet that you have to write off for tax purposes and reporting purposes, right? So total adjusted EBITDA was 1.6 billion. Pro forma EBITDA decreased 31% ex for forex exchanges compared to the prior year quarter, right? This I think is because of all these new expenses and things like that. So cash provided by operating increased to 1.01 billion, and reported free cash flow increased to 789 million, right? So you can see that even though they have a lot of debt, they have free cash flow, right? And obviously free cash flow can be used to pay off the debt, right? So ended quarter 2 with 3.9 billion in cash, gross debt of 53 billion, right? So this is what people are mostly concerned about, right? And if you listen to the earnings call, you won't be that concerned about it, at least for the next 2 years, right? Because I believe their average debt cycle is sorry, it's not called a debt cycle. Their debt duration on average is 14 years, right? So 14 years at a 4.2% interest rates. And that has all been locked in, right? I believe most of it is bonds and all, right? But don't quote me on that. I've yet to see that, right? But all I know is if it's 14 years and it's a 4.2% interest rate, they can choose to pay average interest rate, right? So they can choose to pay the higher interest rates down first, and they only have, I think, about 1 billion due next year, and the year after that, so in 2020, I believe they said they have 2 billion due, and in 2023 they said they only have about 1 billion due, right? So I don't think that's a cause of concern, right? Because you can see that their balance sheet can handle that, right? So for now, the bankruptcy risk is actually quite limited, but you won't know, like let's say they run into some free cash flow issues or they need to take on more debt. At that point in time, you need to reassess the situation yourself, right? So you can see here the 92.1 million direct-to-consumer subscribers. This is HBO Max, HBO Plus, and Discovery subscribers, right, basically. So there is a last factor that I actually forgot to mention in the original video, right, which is this guy, right, David Zaslav. And he is basically the CEO, and I'm talking about the whole management team, right? I'm sure his management team that he brought over from Discovery is good. I don't know them that well, but I know him quite well, right? And I know him well because he's talked about by J. Carl, which is Jason Calacanis, on his podcast, right? He talked about him, and I've done a bit of research into him, right? And he's been absolutely killing it at Discovery. And when he's come over to Warner Brothers Discovery, right, basically he's been cost cutting like crazy. He's been cutting jobs, unnecessary movies, and focusing on quality, right? And that's one of the things that they really focus on in the earnings call, and that is something as a shareholder I will be really like proud to embrace, right? Because a lot of these Netflix movies are actually just pumped out like mass-produced dog shit, right? to be honest. So yeah, I'm very happy that they are focusing on quality, focusing on cost cutting, and focusing on making investments that have actual return on your invested capital, right? That's what they talked about in their earnings call, right? They don't want to grow subscribers at all costs, basically, gain subscribers but not actually make money, right? They talk a lot about making money, and this is like a good capital allocator mindset, which is what drives long-term returns in the company and the stock, right? So just quickly want to explain why debt is actually a good thing, right? So obviously they are running at a 4.2% interest rate. Inflation is at 9.1%, and expected to come down, right? But do think of the Fed and all. So they say, oh, our target rate is 2%. But do you really think they can get it down to 2% without absolutely destroying the economy in the next 2 years, or even in the next 1 year, right? Their projection for 2023 is what, 3-4%, which I think is incredibly unrealistic, right? Because a lot of things take time to work through the system, right? So obviously, if this company will be a strong inflation hedge, right? Unless the economy absolutely gets destroyed, then you have to reassess at that moment, right? And this 53 billion has already been outlaid in the past, right? That's why they can generate 10 billion in revenue. Without all this debt, obviously they cannot generate 10 billion in revenue, and they have the assets on their balance sheet to cover this debt as well, right? If they ever run into problems. But obviously, if you have a distress sale or something, the prices won't be very good for you, right? I'm investing basically because I want the business to be kept alive, right? Not because I think this is a liquidation play, right? So yeah, that's my investment thesis on Warner Brothers Discovery. Obviously, I didn't cover everything, but I'll cover more stuff in the future as well, right? So yeah, if you did enjoy the video, do help me smash up the like button, hit subscribe, and hit the bell button, and comment below, right? What do you think? Did I miss anything in my investment thesis? Actually, I'm sure I missed a lot of things because this is like a 10-12 minute video, right? Obviously, I can't fit all of my investment thesis in it, but I just hope that I cover most angles and give you guys like a wide lens to look through basically this company, Warner Brothers Discovery. So yeah, with that being said, have a fantastic day ahead and peace out.